Might. You're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there is a difference between extreme recession and financial crisis. They're two different things, but they can happen at the same time as did happen in 2008. Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes. But the problem is it might happen
Too late.
anyway. In other words, they might have gone too far. And this almost happened in 2018. And that was my point. It was by the time they realized their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh, gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
Behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Oh, you don't understand, Jim. we have more capital and greater liquidity and less leverage and better credit." And I granted that. I said, you're absolutely right. I said, nice job. You're a stronger bank now than you were then. But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was, at the time, the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. You know, commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants, but could happen anyway. So, you know, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power.
According to Jim Rickards, hyperinflation is coming to America, and the raising of interest rates won't be able to help fight inflation. In fact, it will make inflation even worse. Inflation will impact stock market as Jim Rickards think it will brings the economy into recession, and unemployment will go up to 4 or maybe even 5%. But all Jerome Powell can say is, too bad, that's painful and we have to get there, but we're gonna pay higher prices if we don't. And then there's the myth of 2% inflation. The Federal Reserve have something called inflation targeting, where if they fail to have at least 2% inflation per year, then it means the economy is going into deflation, or to put it simply, the economy is slowing down and therefore unemployment is going to go up and the economy will go into recession. In order to prevent that from happening, the Federal Reserve have to target the inflation to at least 2% per year in order to bring price stability to the market and to keep the economic wheel running smooth. At least that's the theory, but to Jim Rickards it doesn't make any sense. The Fed have raised interest rates way too high, but the inflation is not going down yet. In fact, inflation goes way up even higher than before. People said between 1913 and 2023, the dollar has lost 95% of its value, but we don't need to wait for another 110 years. Jim Rickards explains that in the 1980s, the dollar loses half of its value in just 5 years. Will it do that again? Will the economy goes into recession? Let's find out.
A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. But to your point, Addison, well, hasn't the Fed been raising interest rates? Yes, but real rates are still negative. So if inflation's 9 and the Fed's at 2, the real rate is -7. That's a really, really low interest rate. And if you say, okay, inflation's come down to 6 and the Fed's up to 4, about 4.5 right now. So the real rate is now -1.5 in my example. Well, that's a lot less than 7, but still a negative real rate. We are not in the world of positive real rates. So then the question is, okay, how is the Fed doing at getting inflation to the target, the 2% we talked about, and we explained why that's their number. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know he will probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so in other words, too bad, unemployment's going to go up to some number, I don't know what, 4 or 5%, which is pretty high. It's right now it's 3.4, I believe, the lowest since 1969. So unemployment's going to go up. The economy's going to go into recession, but too bad. That's the price we all have to pay to get inflation down under control. And the way to 2%, in other words, and the way Jay Powell rationalizes this, he said, yeah, that's painful, and we're going to pay a high price to get there, but we're going to pay a higher price if we don't. If we don't get to 2% and we let this thing spiral out of control and we even stay at 4 or 5% for a prolonged period of time, that the economic damage from that in terms of lost investment, misallocation of capital, basically people losing money on their investments, is going to be much higher than maybe a short recession.
Here's the interesting part. Jerome Powell scares the market with 6 speeches. He said the same thing again and again. We need to get to 2% inflation, which means raising the interest rates even more, and therefore we're going to have a recession and unemployment is going to go up. With the Fed being hawkish, the market should go down. Instead, the market got rallied because they believe inflation is going to go down soon. Jim Rickards thinks the Fed is already reached at something called the terminal rate, a rate which inflation will go down on its own, so the Fed won't need to raise the interest rates any further. But the Fed keeps raising it and making the economy crash even further. So how is it going to end? When will the Fed needs to stop raising interest rates? Let's listen to what Jim Rickards have to say.
So he said that the market didn't believe him. The market rallied, went down a little bit right around that time, but then the market rallied in October. And he comes out at the end of September, gives another speech at an FOMC meeting, comes out November 2nd, gives another speech, comes out November 30th, gives a speech at the Brookings Institution, then comes out in mid-December with another speech, and then again a couple of weeks ago on February 1st. So it's like 6 speeches in about 5 months. And he said the same thing every time. He said, we're getting to 2%. Believe me when I said we're going to have a recession. Unemployment's going to go up. Too bad. We have a lot of work to do. We're not done. The market has flipped on and off. Half the time the market doesn't believe me. Go, yeah, you say that. But in fact, inflation is coming down faster than you thought. You're probably, I should introduce a concept. I guess a lot of people have heard of it, but there's this new concept called the terminal rate. The Fed's trying to get to the terminal rate. And so what's the terminal rate? Well, no one actually knows what the number is. I don't know, but neither does Jay Powell. But it's a theory. And the theory is, okay, the terminal rate is a rate set by the Fed that's high enough to bring inflation down without further rate hikes. We get to a level, and that level is high enough that inflation will come down on its own just by waiting without raising the rate again. And the conundrum, I hate to use that word, but it is a conundrum. The conundrum the Fed faces right now is they have been raising rates and inflation has been coming down. Those two things are true. But is inflation coming down because they're raising rates, in which case maybe you want to keep raising them, or are you already at the terminal rate? It's coming down on its own, and now the danger is you're going to go too far. And that's the debate with Wall Street. And so Wall Street is sort of leaning to the view, now you're probably already at the terminal rate. Inflation's coming down. You need to back off. You need to stop and probably pivot. This was the famous word for the last 6 months. The pivot means you're actually going to have to cut rates. Because you have gone too far and you're going to cause a pretty bad recession. And so the expectation as recently as December was that the Fed would pivot around March or April. They would raise in February, maybe March, but pretty quickly after that they would cut rates. And if the Fed's cutting rates, buy stocks. It's typical Wall Street analysis. It always ends with buy stocks, particularly tech stocks.
So, with the current high interest rates environment and reckless government spending, what should we do to protect our money from inflation? Should we buy stocks? And what stocks should we buy? The Fed said it will raise the interest rates even further, but the market thinks the opposite will happen, so who's right and wrong here? Let's hear what Jim Rickards thinks. Spoiler alert, this is not investment advice.
But the Fed has been saying the opposite. So there's been this battle where Powell goes 1, 2, 3, 4, 5, 6 speeches, says the same thing. We're not stopping. And Wall Street says, oh, yes, you are. So buy stocks. Well, who's right? Well, there's an old saying on Wall Street, don't fight the Fed. I don't think of it as who's right or wrong. You could have an opinion. The way I think of it is I just want to know what you're going to do. Because if I know what you're going to do, then you can trade accordingly. You can plan for that and you can prepare for it. And what they're going to do is they're going to keep raising rates. Even if they're at the terminal rate already, I think they might be. Even if they are, they don't think so. Their opinion counts for a lot more than mine. And they're going to keep going. But by the time inflation comes down enough to say, yeah, okay, we're at the terminal rate, nice job, it'll be too late. They will have gone too far because the Fed's always the last to know. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo. They're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse. And it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a a big red siren, a flashing light, whatever you want to call it. Interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. Inventories are sky high and new orders are being slashed. You're not moving anything by truck. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds, and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018, less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because there's the, bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions, like '08, like '01?
The answer is yes. First of all, we're seeing it already. So, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good debt. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right. You're in the military. Yeah.
You're in the There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's the depression level of unemployment. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, Biden, they're all a big deal. If in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, because everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. We know that the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. There's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the real The market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on
Yeah,
the back
and I'm
of a
not
recession.
alone. That is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20, 30%?
Yes. And again, you have to remind people. 1929, the stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down. The S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you, you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. That was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the situation we're in today is very different from the 1970s, and I'll explain why. But let's explain why right now. Because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to to $6. Okay, but percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was, the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value." Benefit programs, they have government contracts, they do whatever they do, but when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch. And the Fed is an independent agency, and the Federal Reserve banks are actually privately owned. A lot of people know, some people know that, some people don't, but the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate, but the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing, and if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory, general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. The curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. Why are those residential real estate prices going up? And the same thing's happening in the United States. The answer is that there is an exodus, and I don't think that's too strong a word, out of the cities. People are put off by, cities have always been a trade-off. Cities are, okay, you have a lot of noise and some dirt and some hassles and maybe a slightly higher crime rate. But on the other hand, you have art and culture and museums and shows and restaurants and bars. And so you make a trade-off. You say, I'll accept these annoyances in exchange for all this, culture and buzz. And cities attract, the brightest people. So whether it's, bankers or lawyers or doctors or artists, playwrights, actors, whatever. It's just, there's a lot of buzz. That's why people go to cities. With these lockdowns, we've amplified all the negatives and taken away all the positives. We've shut the museums, the restaurants, the bars, the plays, the office buildings, things that attracted people. But meanwhile, again, probably not as bad in Australia as it is here, but crime is on the rise. Murder rate in New York has doubled. Suicide rates across the country have tripled. And that's New York, the suicide rate's national. There are all these dysfunctions, and a lot of them, and of course, when you have highly concentrated populations, which you do in cities, a lot of that's worse. So what people are doing, I say people, it's the people who can afford it. They're getting out of the cities and they're going to nearby suburbs or even further out, what we call exurbs, which are, the next ring beyond the suburbs. And so there is that demand for housing. I'd be willing to bet money that the place you're describing is a pretty attractive neighborhood. So they're booming, and the same thing's true in the United States. But what's the other side of that? We're depopulating our cities. Cities are the greatest wealth generating phenomena in the history of civilization. That's what civilization means. It means cities. And so if we're depopulating and draining our wealth creating engine, what does that do to the economy long run? So as an individual choice, it makes sense and I understand it. But the macro effect is we're depopulating these wealth generating places. I mean, just take any downtown area. It could be Melbourne or Adelaide or Sydney or New York for that matter. If there's an attractive downtown office building, let's say you're a large company, insurance company, whatever, and you used to have 10 floors as your corporate headquarters. Well, now everyone's been working from home for almost a year. That's nothing that anyone would have recommended, a year ago. But we were forced to do it, and guess what? It works. Employers and employees are finding that, hey, it works. You can communicate and get stuff done, and maybe there's some attractions to it. So this work from home thing is here to stay. What companies will do, they'll say, well, instead of 10 floors, I only need 2 floors, and I'll have attractive offices, but you'll reserve them. You'll call up and say, hey, I need an office 2 days next week to meet some clients. Done. They'll build locker rooms. They won't be like high school locker rooms. They'll be very attractive. You'll keep your laptop and your sweater and your scarf or whatever in your locker. You'll show up, take your stuff out of your locker. Some receptionist will tell you which office is yours for those 2 days. Set yourself up, meet your clients, go home and work from home. What does that mean? If you cut commercial real estate capacity or utilization by 80%, we'll start with the cleaning crew and the reception, but what about the food trucks, the restaurants, the shopping, the public transportation, drinks after work, on and on and on, all the things that are ancillary to that downtown office location. You cut that by 50 to 80%. What is that doing to your economy? So these are examples. By the way, this will take a year to play out. This is not an overnight thing. So the tenants are not paying rent. If they are, they've called up and negotiated a 50% increase. I have some involvement in commercial real estate, and I see this in real time. So rents are down by perhaps half or all the way to zero if they're not paying. And everyone says, well, landlords are rich. No, they're not. The landlords take the rents, but they have mortgages. So if the tenants aren't paying the landlords can't pay the mortgagee, and that falls on the banks, right? Except the banks are clever. They've securitized it and sold it probably to you and me, right? We have our 401ks like a superannuation fund, but you look in the fund and do you have some commercial real estate REIT or something that Morgan Stanley sold you? Well, maybe you do. And what's inside? No one knows, but take a look. But that ripple effect I just described can take a year to play out. So we haven't seen the end of this. So the bottom line on all this is that interest rates are going up in anticipation of inflation based on handouts. The reality is the handouts are not being spent, they're being saved, which does nothing for inflation. And it's also not sustainable, which is what are you going to do? Hand out a $2 trillion deficit spending package every 6 months? Because that's kind of what we've been doing since last summer. And they keep saying, well, this is the last one. It'll be sustainable. It's not sustainable. It's a handout and people need the money. But if they put it in the bank, which they're doing, this is a classic liquidity trap. So what's going to happen? Yeah. But meanwhile, the interest rates are going up, perhaps for the wrong reason, but they're going up. That's going to slow the economy further. We're already seeing mortgage applications dry up. We're seeing the housing not bubble, but pretty steep increase in residential housing starting to level up. So by, hard to say, but I would say by March or April, this whole thing is going to go in reverse. Everything we just talked about is going to go in reverse. The economy is not going to have the traction. Unemployment is going to remain high. Velocity is going to continue to drop. There's not going to be any inflation. Those interest rates are headwind. They're going to drop, and the price of gold is going to shoot up. So my advice to potential gold investors is it's on sale. Go get some right now. It's always better to buy low and sell high. And but I would expect the price to be much higher by mid-year.
I know that you've said this before, or I'm pretty sure you've said this before, that to stimulate an economy, you need to reduce interest rates by somewhere around 3-4% to have an effect. When interest rates are currently at zero, how can you do that? Where do you go from zero?
Well, a couple of things. The short answer is you can't. You in theory, you can go to negative rates, but negative rates don't work. We have experience from the ECB, Sweden, Japan, Switzerland, elsewhere, that negative rates don't work. They're negative rates, but they don't. It's not more of the same. Cutting rates from 3% to zero has a beneficial effect, but cutting them from 0 to -1, now you're through the looking glass. You don't get any more pop. You don't get any more bang for the buck. And there are reasons for that, which are what, as a central bank, what signal are you sending? Well, see, the idea of negative rates is you're going to spend the money, because if I'm going to take it away, you put money in the bank, even at zero, you put money in the bank, you go away for a year, come back, the same amount of money should be there. That's the zero interest rate. But a negative interest rate, negative 1%, you put $100,000 in the bank, you go away for a year, you come back, you only have $99,000 because I took $1,000, that's 1% negative interest. So the idea is, if I'm going to take your money, you're going to spend it fast because you don't want me to take your money. And that's going to have the stimulative effect that we talked about. That's not actually what happens. What happens, two things. Number one, people have lifetime goals. Their retirement, their healthcare, their parents' healthcare, their children's education, buying a house. There's some large lifetime goal you have, and that's why you save money in the first place. If I'm taking your money away, you're going to save more, not less. You still want to achieve that goal. I've made it more difficult, but you're actually going to save more. They want you to spend it, but now you're saving more. And the second thing is, what signal is a central bank sending when they have negative interest rates? They're saying that they're worried about deflation, not inflation, but deflation. Yeah. So if they're telling me, if central bank is telling me that deflation is a problem, I'm going to wait. Why should I buy anything right now? Wait till the price drops. And by the way, a negative interest rate, negative 1%, my example, is a nominal phenomena. But in real terms, if you have deflation, my money is worth more. So even though my dollar amount may be less, my purchasing power went up because prices went down. And so that's why negative interest rates don't work, because A, you're sending a deflation signal, so people defer spending, and B, they have lifetime goals, so they actually save more. So negative rates don't work. So you see, you're right, you're stuck at zero, there you are. Pardon me, you can do QE, you can do quantitative easing. And usually what happens is they hand the ball over, I don't know if it's a rugby match or whatever, but they hand the ball from monetary policy, which is now impotent, to fiscal policy, which is deficit spending. But there you have other kinds of headwinds having to do with very high debt levels. More to the point, in terms of what a central bank can actually do, they can't stimulate. They can print money, and governments can spend money and incur deficit spending. But again, none of it does any good if people don't actually spend it, and that's a psychological phenomenon. And the Fed or the Reserve Bank of Australia or any central bank can print money, no doubt about it, but they can't change people's psychology. We had an external shock, an exogenous shock in the form of the pandemic that caused people to stop spending, save more, or they were unemployed, or if you're the unemployed individual, you're not taking your friends out for dinner these days. You're putting money in the bank, and even if you still have your job, you're going to save money because you're worried you might be next. You might be the next one to get laid off, or your company might shut down next week or next month. And so you're going to save more. It's what economists call precautionary savings, or, in plain English, saving for a rainy day. And that's what's going on. It's going on all over the world. This banking crisis is far from over. All the dominoes never fall at once. They fall sequentially. And sometimes there are time gaps between them. And everyone says, oh, all good. It's not all good. You have to look behind the curtain of the international monetary system, understand what's actually going on. These failures are symptoms more so than the real problem. The real problem has to do with tight money. Interest rates are 5%. They're going to be, 5.25%. But that is a year or just over a year ago, March 2022, they were zero. So you go from 0 to 5.25% in about 1 year. That's extraordinary. I mean, people remember Paul Volcker raised interest rates to 20%, and he did, but that played out over a couple of years. This is 5% in 1 year, and the Fed's not done. I mean, they're saying, we're going to think about it. We want to look at more data, but they have not said we're done. This whole pivot narrative has been wrong for a year, and it's wrong now.
This banking crisis is far from over. What a great news to start our day, eh? Jim Rickards said that the banks will never fail all at once. You have to be cognizant of the situation, like the market condition, public confidence, and of course, the interest rates. One of the easiest indicators of a healthy economy is the interest rates. If the economy is in a red-hot inflation, then the Fed has to raise interest rates in order to cool down spending and encourage the public to save money because they will earn more interest with their bank. The Fed has raised interest rates from 0.5% to 5.33% in just 1 year, the fastest and highest in the history of Federal Reserve. But the inflation hasn't come down yet, so the Fed has to keep raising the interest rates. This whole pivot narrative has been wrong for over a year, Jim Rickards said. The Fed will never do a pivot. Pivot means stop raising the interest rate and instead start cutting it down. The Fed will keep raising the interest rates until they bring inflation down. A good bank risk manager will think, the Fed is raising the interest rates, it means the bond price is going down. I think I should sell my bonds so that all of my bank deposits will not lose any value because of the bond prices going down. But instead these bank managers do the opposite, so people will take their money from the bank. Jim Rickards said it will be worse than the 2008 global financial crisis. Let's hear more from Jim.
So we have tight money, we have underwater bonds, we have bank management who don't know the first thing about risk management. If you knew anything about risk management, once the Fed said, hey, we're gonna raise rates until we kill inflation. And that is what they said. Jay Powell gave 8 speeches between the summer of 2022 and recently, and he said that every single time. Well, if you're a bank risk manager and you hear that, you're like, I got bonds, interest rates go up, bond prices go down. I understand their unrealized losses unless I sell them if they're in what's called a hold to maturity account, but they're still losses, and it still destroys confidence. Now, bank runs today, you don't have to line up around the corner in the rain, with your hat on, waiting to see the teller. You can just do it with your iPhone, and to the tune of, you can move $1 billion with your iPhone if you with the right accounts and passwords and all that. And so that's what happens. So the bank runs are instantaneous. And they're far from over. So yes, a little, kind of in a quiet period, but there'll be more. And the good analog, Matt, is the 2008 financial crisis. Everyone remembers, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy. And that's true. But that started in the spring of 2007. When HSBC reported disappointing earnings based on mortgage losses, and then came to a head in August. 2 Bear Stearns hedge funds failed. There were high yield mortgage funds. At the end of July, August, the Fed raised the discount rate. It took a full year, another 13 months, to get to Lehman Brothers. And what happened along the way? Bear Stearns in March 2008. Fannie Mae went bankrupt in June 2008. Freddie Mac bankrupt in June 2008. Congress bailed out the system in August 2008, and then Lehman Brothers. So that took a year and a half, and there are a lot of crises like that. So we're in falling dominoes. It's not over. It'll get a lot worse, and people should prepare for that. But as usual, they don't. People are very complacent. Wall Street says it's all good, and people believe it, but they shouldn't.
Jim Rickards has explained the current predicament that we're in. It's the tight money policy because of the high interest rates. This situation is very similar to what we had back in 2008 when Bear Stearns, Fannie Mae, and Freddie Mac got bankrupt because the Fed is raising the interest rates. It's similar to what we have now, where the interest rates is very high and the banks are hesitant to lend money to anybody. So, how the situation will end? Spoiler alert, it's far worse than you thought.
Well, it either ends when, it can end 2 ways. One is something like 2008, but worse, just a generalized global financial crisis where everybody's getting the money out of every bank, either buying treasury bills. Treasury bills at a brokerage firm are pretty safe because it's not about the brokerage firm. Brokerage firms fail all the time, but they have to segregate house fund, proprietary funds, and customer funds. Money market funds, same thing, in the sense that in 2008, the government proved that they're willing to bail out money market funds. And they did, guaranteed every money market fund in the country. So the best safe haven is gold. I say physical gold, bullion, coins or bars, and silver. It's not digital. You can't hack it. You can't steal it, and you can't freeze it. You just put it in a safe place. So Americans don't really get gold. They don't really understand it. So I think it's just going to be a question of frog hopping from lily pad to lily pad, looking for a safe place. The other scenario is that the government just throws in the towel and says, okay, all deposits are guaranteed in unlimited amounts. I knew people who were trying to get $8 billion out of Silicon Valley Bank on that. They sent the wire instructions on Thursday night. One guy I talked to said, hey, Jim, from Thursday night to Sunday, we didn't know where the money was. We sent the wire instructions. We were trying to get it out, but we didn't know what the outcome was going to be, whether it was short or not, wire sent or not. And then Sunday night, the Fed and the FDIC came out and said, all good. We're going to, business as usual, open Monday, and it's all good. And he said the money went through, but that was what people were facing, and they'll continue to face. The banks you mentioned, I don't know what their deposit flows are right now, but my guess is they're shrinking fast. People are getting their money out. And so you might just have to give a generalized blanket deposit insurance protection, and that would stop bank runs in theory. But then now you basically nationalize the U.S. banking system. You look like Argentina. So there are no, I guess the way to put it, Matt, there are no good outcomes. Either there's a catastrophe worse than 2008 that starts to look like 1931, 32, or the government offers so much protection that they've de facto nationalized the banking system. But the one thing I've noticed is that each crisis gets bigger than the one before, and each bailout is bigger than the one before. And the question I'm asking as an analyst is, are we at the point where the crises are so big, it's bigger than the Fed? In other words, we're not really talking about bailing out a bank or a sector. People lose confidence in the dollar itself. And we do seem to be heading in that direction.
Jim Rickards said the crisis will get bigger than the one before. In 1999, Wall Street bailed out the market, and in 2008 the Fed bailed out Wall Street, and now, who will bail out the Fed? Jim proposed the idea of the dollar collapse. People often misunderstand the concept of the end of the dollar as the global reserve currency and as a payment currency. Let's listen to what Jim Rickards has to say.
But I find there's a lot of confusion on the topic. And the confusion comes from the fact that everyone talks about the end of the dollar, the dollar's going away as a global reserve currency, etc. But people don't distinguish between the role of the dollar as a payment currency and the role of the dollar as a reserve currency. And those are two very different things. There's some linkages, but a payment currency, basically, if I want to buy goods and services from you, and I tender some form of currency and you're willing to accept it, and you're confident someone else will accept it from you, that's a good payment currency. It could be dollars, it could be euros or yuan, or it could be Russian rubles or Brazilian reais or anything, as long as people are willing to accept it, have confidence in it. A reserve currency is a very different thing. First of all, we don't really have reserve currencies. You know, you go to the People's Bank of China, they don't have $100 bills stacked up in the basement. What they own are U.S. Treasury securities, which are digital, by the way. The last paper Treasury security was issued, I think, around 1979. So what they have are actually securities. So when people say reserve currency, what they really mean is securities that hold your reserves denominated in a currency. So, of course, Treasury securities are denominated in dollars, but they don't have actual dollars, in a bank account or in physical form. They own securities. Now, as far as the payment currency is concerned, that's relatively easy to displace. This is what all the news is about. So the BRICS, that's Brazil, Russia, India, China, South Africa, they're working on a new payment currency, and that we're likely to see a big rollout of that this coming August. Don't know exactly what it'll be. They're working behind the scenes. It could be commodity backed. It could be gold backed. I'm not predicting that, but that's certainly one of the possibilities that we need to look at. But there is one thing that could knock the dollar off, which is gold. Gold is just gold. If you have physical gold, bullion or coins, you don't need all that other stuff. You just put it in a safe place and guard it, like Fort Knox or whatever the Russians and Chinese have their equivalents, and just sit on it. It's not digital. You can't hack it. You can't freeze it, etc. So if someone said, so the idea of the dollar losing ground as a payment currency is completely plausible. It'll happen in stages, and it's happening already. The idea of the dollar losing its role as a reserve currency, it's not going to lose it to another currency, but it could lose it to gold. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less.
The economy is in a huge mess. Jim Rickards said that this is the best single indicator of a recession. An inverse yield curve is when a yield on a 30-year bond is lower than a 10-year bond. Simply put, you get more money by saving it in less time. Normally, you should get more money when you save it for longer because the risk is bigger. You have to wait for more time in order to get your money back. But instead, investors prefer the shorter bond because they're afraid that the economy might be in a recession, meaning that the economy is slowing down. Jim Rickards said that there are at least three markets: the stock market, the bond market, and the real market. If the economy is in a recession, stocks and bond markets usually know it later, but the real market knows it first. When the sales go down, they have to cut costs. And eventually, they have to fire their employees. Entrepreneurs and small businesses know it best when it comes to the state of the economy because I believe that Jerome Powell never bought groceries by himself. So, how could interest rates go up if we are in a recession? The fact is that the interest rate is a lagging indicator. Let Jim Rickards explain it to you.
Interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. if I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks. Bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down.
Jim Rickards said that the Federal Reserve will only care enough if it's a disorderly collapse, meaning if the markets, either stocks or bonds, are going down like 30% in just 2 weeks. If it's just a little plunge in a day like a 5% drop in Amazon stocks, then the Fed won't care about it. But what the Fed and everybody is missing is the state of the economy itself. The unemployment rate is at its worst now, and massive layoffs in the tech industry are in the news everywhere. Because of what, you might ask? Yes, you are correct, it's because of the high interest rates. The companies need to pay more for the interest on their debt, so they have to reduce their headcount. At the same time, their revenue decreased because consumers unsubscribed from their services because of the rising prices everywhere, whether it's groceries, gas, or even food. So yeah, everything will go south, I guess.
Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, oh, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment.